Welcome to the Opening Bell Report.
There are some stocks on your watch list that they just sit there. You look at them every day and it's the same old story. Down a bit, up a bit, basically in a coma. And for a lot of us, that's been Plug Power for months. Just stuck in the mud around that $2 mark.
It's the kind of price action that just puts you to sleep.
Yeah.
Pure consolidation.
Until yesterday. Because if you had PLUG on your screen yesterday, you probably spilled your coffee.
Agrees. Yeah.
We're not talking about a little flicker of life here. We are talking about a full-on eruption. The sleeping giant didn't just wake up, it kicked the door down.
It was a violent move, honestly. When a stock that's been basic for so long suddenly puts up a double-digit gain in one session, the market pays attention immediately.
And let's get specific on the numbers. We saw a 16.67% jump.
In one day.
In one day, which is just massive. And the volume poured in, the chat boards were, lighting up like a Christmas tree, and suddenly everyone is scrambling. So that's our mission for this deep dive. We've got this analysis report in front of us, and we need to answer the big question. Is this just a dead cat bounce, a cruel fake out before it heads back to $2? Or did we just see the start of a massive short squeeze?
That is the million-dollar question. And what's interesting about the analysis we're looking at is that it doesn't just, hype the move. It actually gets under the hood and looks at the mechanics.
Okay.
We're talking momentum signals, the breakout structure, and, of course, the incredibly dangerous spot that short sellers are in right now.
Oh, we are definitely getting to the short situation. The numbers there are staggering. But let's start with the anatomy of the move itself. You said the stock was basing. So for our listeners who follow the technicals, this wasn't just some random spike, was it?
No, and that is a crucial distinction. A random spike on like a rumor usually just fades away.
Right.
This is a technical breakout. So the stock closed at $2.59 of 37 cents. Now, 37 cents, it might not sound like a lot if you're trading a huge stock.
But on a $2 stock, that's a monster move. It's all about the percentage.
Exactly. And the report specifically calls out the 50-day moving average,
which had been the ceiling.
It had been this oppressive ceiling for months. Every time the stock tried to rally, it would hit that average and just get slapped right back down.
And yesterday?
Yesterday, it didn't just nudge past it. It smashed through it on high volume.
Which tells the algorithms and the big institutional desks that the trend might have finally shifted.
It forces them to chase.
Huh.
When you clear a major average like that, the script flips from sell the rip to buy the dip.
Okay.
The report also notes that this move fills a previous gap on the chart.
And gap fills are powerful. It's like the market has a memory, and it has to go back and fix that hole. But here's what I'm wondering. We see these kinds of breakouts all the time on penny stocks that just fizzle out. Does the report see signs of, real money here? Or is this just retail traders having some fun?
The volume profile suggests it is not just retail. You don't get a 16% move with this kind of buying pressure without some institutional footprints.
Okay, so there's some weight behind it.
There is, but the analysis does pump the brakes a little.
I noticed that. It's not all clear skies ahead.
Not yet. Closing at $2.59 was a big win for sure. But the report identifies the, quote, real war zone at the $3 level.
$3? Why is that number so important?
Well, it's psychological and it's structural. Whole numbers are always magnets for sell orders. People set their limit sells at $3, not, $2.97.
Right.
And if you look at the chart history, there's a lot of overhead supply there. People who bought at $3 on the way down are just waiting to get out.
Ugh, the break-even crowd. They've been holding on for months, just praying to get their money back so they can sell and just forget about it.
Exactly. So that $3 mark is going to be a wall of sellers. The breakout has started, but the war is not won until it clears that level.
Okay, so that's the technical picture. Breakout is confirmed, but the next big test is $3. Now, let's get to the spicy part. The part I think is really driving this frenzy.
The short interest.
The short interest.
This is what the report calls the squeeze fuel. And honestly, looking at these numbers, it is highly combustible.
I was looking at the data in the report, and I actually had to double check it. I thought, is this right? The short interest is sitting at 25.16% of the float.
It is remarkably high.
I mean, think about that. We're not talking 5 or 6%. We're talking about a quarter. A full quarter of all the available shares have been sold short.
It's a very, very crowded trade. And when a trade gets that crowded, it becomes dangerous. Not for the company, but for the people in those short positions.
Okay, so let's walk through the psychology of this. If you are short PLUD, you're betting it's going down maybe to $0. You're feeling pretty good at $2. Then suddenly, in one trading day, the stock rips 16% against you.
It's a nightmare. And here's why. Your risk is unlimited. If you buy a stock, the most you can lose is what you put in.
It goes to $0.
Right. But if you short a stock and it goes on a huge run, your losses can be infinite. So when you see a 16% jump like that, your risk alarms are screaming. You are, as the report says, sweating.
And the only way to stop the bleeding is to buy the stock back.
You have to cover your position. But here's the trap. If 25% of the float is short, and all those people try to run for the exit at the same time,
the door's not big enough.
it's way too small. There aren't enough sellers to handle all the panicked shorts trying to buy. So what do? They have to bid the price up. They offer $260. No one sells. $270. Still no one. They have to pay whatever the market is asking just to get out.
Which creates a feedback loop. The price goes up because shorts are buying, which then scares the other shorts, so they start buying, and next thing you know, you have a vertical line on the chart.
That's the perfect anatomy of a short squeeze. And with 25% short interest, the fuel tank is completely full. The analysis projects that if this thing really triggers, we could see this stock push to $4 or even higher very quickly.
That's almost a 100% move from where it was.
It is. Yeah. And squeezes aren't gradual, they're violent. They're an explosion.
It feels like a poker game where the bears just realized the bulls are holding 4 aces.
And the bears went all in with borrowed money.
Agrees. A terrible place to be. But, okay, I want to pivot here. Because if we just stop now, the takeaway is buy PLUG, go into the moon, free money.
And it is never that simple.
Never. We have to look at the other side. We can't just get high on the squeeze fumes. We have to ask, is Plug Power actually a good business? Or is this whole rally just, a speculative gamble?
This is the reality check part of the analysis. And yeah, it's a bit of a cold shower after all the squeeze talk.
So the report dives into the fundamentals. And there's one number that looks good on the surface. Revenue is up to 21%.
And, on its face, that sounds great. 21% growth. You think, okay, this is a growth company. They're selling more product. And that's true. They are.
Wow.
But growth is only half the story. The more important question is, how much does it cost them to get that growth?
The report had a metric that I found pretty jarring. It was the dollar analogy.
It's the metric that keeps the long-term investors away. The analysis points out that for every $1 Plug Power makes in revenue, they're spending about $1.10.
Let that sink in for a second. You run a lemonade stand, you sell a cup for $1, but it costs you $1.10 for the lemons and sugar. The more lemonade you sell,
the more money you lose. It's profitless prosperity. You can grow your revenue to the moon, but if your unit economics are negative, you're just digging a deeper and deeper hole.
It's the old .com joke, right? We lose money on every sale, but we'll make it up in volume.
And we all know how that story ended. This is the fundamental problem with Plug Power. They have the story, they have the tech narrative, they have the revenue growth, but the cash burn is a huge anchor on the company.
So they constantly need new cash just to keep the lights on?
Exactly. And the analysis brought in a comparison I thought was really useful. They put PLUG next to Bloom Energy, ticker BE.
Right.
Because investors tend to lump all these green energy stocks together. But the report draws a really sharp line between them.
Is Bloom sort of the adult in the room?
In terms of their financials, yeah. Bloom has much better margins. They aren't burning cash at the same alarming rate. So the report basically frames Bloom as the investment and Plug Power as the speculation.
That's a huge distinction.
Yeah.
If you buy Bloom, you're betting on the long-term hydrogen economy. If you're buying PLUG right now,
you are trading the volatility. You're betting on the squeeze. You're betting the price is disconnected from the fundamentals, at least for now. Because if you just looked at the balance sheet, that $1.10 for $1 metric, you wouldn't touch it.
So PLUG is the speedboat with a massive engine but a leak in the hull. And Bloom is maybe a slower boat, but at least it's not sinking.
That's a perfect way to put it. And that leak in PLUG's hull brings us right to the biggest risk for anyone who's bullish on this.
Dilution.
Dilution. It's the word that strikes fear to the heart of every shareholder.
So explain how that plays out here. The stock is rallying, which seems good. Why does that increase the risk of dilution?
Well, put yourself in the CEO's shoes. You know you need cash to run the company. You see your stock just jump 16% in a day on massive volume. What do?
You sell stock.
You sell into the rally. You issue millions of new shares to raise capital while the price is high and the buyers are there. It's the smart move for the company's survival, but for existing shareholders, it's brutal.
Because all of a sudden, my piece of the pie just got smaller.
Your equity is diluted. And what usually happens when a company announces a stock offering, the price tanks. Immediately. That is the bear case the report warns about.
So the fear isn't just that the business is losing money, it's that the company itself will kill the rally to raise cash.
Exactly. It's a tug of war between the market squeeze and the fundamental reality of the company's needs.
So let's map out the two paths forward here. The analysis gives us a bull case and a bear case. Let's start with the bulls. What has to happen for this rocket to keep going?
For the bulls, everything hinges on that $3 level we talked about. The analysis is very clear. The stock has to break $3. and hold it.
It can't just peek its head above and fall back down.
No, it needs to close above it convincingly. If it can do that, the report sets a technical price target of $4.58.
$4.58, wow. That's the full-blown squeeze has squoze scenario.
That's the scenario where the shorts totally capitulate, the FOMO buyers pile in, and momentum just completely takes over.
Okay, now for the bears. What are they watching for?
The bears are watching for a rejection. The report highlights the $2.60 level, which is basically right where we closed. If the stock tries to push higher from here and fails, it gets slapped down.
Then the bear case is on.
And the bear case takes over.
Yep.
And the target is back to the baseline, $2.
So the entire move just gets erased.
The move gets erased, the shorts get their confidence back, and the stock goes back into hibernation. And the catalyst for that rejection would likely be the very dilution fears we just discussed.
It really is a battleground stock. You can see why people are so passionate about it. It's not just will it go up, it's will the company let it go up.
It's a game of chicken between the traders and the company's CFO.
So to wrap this all up, we have a stock that just exploded. We have an insane amount of short interest that could act as rocket fuel. But we also have a business model that's fundamentally broken at the moment and a management team that probably needs cash.
It's the absolute definition of a high-risk, high-reward setup.
And what I love about this report is how it frames the final takeaway. It's not just about PLUG. It's about you, the investor, and your style.
It poses a really great question at the end. It asks, in a market that's driven by momentum versus fundamentals, are you the kind of person who buys the breakout, or do you fade the rally?
I want to focus on that phrase, fade the rally, because it's really hard to do. You see a stock up 16%, all that green, you feel the FOMO, your brain is just screaming, buy, buy, buy.
That's the emotional brain. Fading the rally takes immense discipline. It means you look at that green chart, you say, no, the fundamentals don't support this. This is noise. I'm going to bet against it. Or, at the very least, I'm staying away.
It's the core difference between a momentum trader and a value investor, right?
Yeah.
The momentum trader sees the breakout and chases the squeeze. The value investor sees the cash burn and just assumes gravity has to win eventually.
And neither one is necessarily wrong. They're just playing completely different games with different time horizons. The question the report leaves you with is, which game are you trying to play with plug power?
That's the perfect place to leave it. If you're playing the squeeze, you're watching that $3 level like a hawk. If you care about the balance sheet, maybe you watch this one from the sidelines.
Or you go look at Bloom.
Agrees. Or you go look at Bloom. Exactly. It's going to be a fascinating week for PLUG. We will be watching.
Absolutely. Keep an eye on that volume.
Thanks for diving in with us today. It's a wild market out there, so stay safe. We'll catch you on the next deep dive.
Goodbye, everyone.
Don't forget to like, share, and subscribe for more.